In the last session, we worked through a long buy position where we paid interest for each day we're in the trade. In this session, we're going to be discussing the benefits of short selling. In this case, it'll be a carry trade where we'll be actually receiving interest for each day we're in the trade. Let's go through the basic strategy for short selling. So everything's in reverse for short selling. So our initial short sell signal is to look to short sell when the 13-period weighted moving average crosses below the third last upward plotting parabolic SAR dot. So the 13-period weighted moving average crosses down below the third last upward plotting parabolic SAR dot. The other method you could use if you're unable to watch for the crossover signal is to simply place a non-stop short sell order below the sixth last upward plotting parabolic SAR dot on your chart. So sometimes we're not always in a position to sit there and wait for that crossover. So we're placing an on-stop short sell order below the sixth last upward plotting parabolic SAR dot. If the price action does start to turn down, we should be triggered into the trade on the way down as the reversal begins. Now, for the initial stop, again, everything in reverse is placed above the last peak from where you've entered the trade. So somewhere on the chart, you're prepared to admit it's no longer going down, you're wrong about it going down, so putting it above the last peak is a perfect place for your initial stop. Now, trade risk, generally 1 to 2% per risk per trade. All right, that is the maximum risk being suggested because of the volatile nature of the FX market. We also have a pyramid signal where we can add to our position on a short sell. So add to your position in an established short-term downtrend when you get a close below an upward plotting 13-period weighted moving average. So close below an upward plotting 13-period weighted moving average. And obviously that suggests a resumption of its downtrend is likely if we see a close below the upward plotting 13-period weighted moving average, and therefore a good time to add to our position. Suggestion is to only add to your position once during the life of the trade. And again, place your stop loss above the last peak as you would with your initial entry. And this gives us the benefit of adding to a position, hopefully maximizing the profit out of our established short-term trend. In terms of a trade management method, we're going to trail our stops above the sixth last downward plotting parabolic SAR dot in the downtrend. So you can actually have your stop loss above the sixth last downward plotting parabolic SAR dot in the downtrend, or simply look to exit when the 13-period weighted moving average crosses up through the third last downward plotting parabolic SAR dot. So look to get out when the 13-period weighted moving average crosses up through the third last downward plotting parabolic SAR dot. All right, so here is an actual example of a short sell entry signal. So moving average, which is a 13-period weighted moving average, is turning down. You can see it's crossing down through the third last upward plotting parabolic SAR dot there. So we're looking to initiate a short sell at 0.7047. That's roughly where you're going to be entering as the moving average crosses down through that third last upward plotting parabolic SAR dot. Initial stop loss is typically placed above the last peak, which is in this case 0.7077, and that's our stop loss to take us out of the trade if we are wrong about it going down. So obviously rallying and exceeding the peak is a pretty good indication we're wrong about it going down, so that's where our stop would go. Obviously we're short selling. Notice you're opening the trade by short selling, and therefore you only profit if the trend goes down. If it starts to go up, we begin to lose money. So that is the whole purpose of short selling. It allows you to profit from downturns, in this case from a currency pair, which is the Aussie US dollar. Okay, so looking at our trade, we've decided to do a short sell on the Aussie US dollar, referring to our interest rates list here. At the time of this presentation, we had the Reserve Bank of Australia with an interest rate of 1%, US Federal Reserve at 2.5%. So because it's a short sell on the Aussie US dollar, we're actually entitled to receive interest for each day we are in this position. So we'll be paid interest on this one as opposed to paying it. So that's a good thing. That works in our favor. So let's go through calculating our position size. Step one, select your, I'm just using the position size calculator from the members area here to demonstrate this. So select our account currency, being Aussie dollar. Our account balance, just assuming a $20,000 account there, we want to risk 2%. And we've established that our trade risk is 30 pips. So you're entering at 0.7047. Stop loss above the peak is 0.7077. So the trade risk is 30 full pips. So put that in there. Select the currency pair from the drop-down list. So we want to select Aussie US dollar here. And the actual entry price we're entering at is 0.7047. Our position size we're able to trade in this case is $93,960 contract. So you'd probably round that up to $94,000 contract there. And we're risking $400 obviously for the trade. All right, so just double checking our risk, again, using a few online calculators here. So the profit/risk calculator can also tell me my risk. So I'm selecting a short sell. We're trading basically a $94,000 contract, opening price 70.47, closing the trade at 70.77, says we'll be risking $404, which is close to our $400 risk we were talking about. Remember, we rounded it up to $94,000 contract. Working out what is the value per pip on this, per full pip. So we select the currency pair. So this is the pip calculator from the members area. Select the currency pair from your drop-down list, Aussie US dollar. Type in your contract position size, being a $94,000 contract. Type in your entry price, which is 0.7047, and want the value to be displayed in Australian dollars. And that's telling us that our value per pip is $13.33. So that is what we stand to make or lose for each full pip move in our favor or against us. And of course, the carry trade calculator, another online calculator that you could certainly use and take advantage of, is telling us that we're going to be paid interest of $3.86. So we're selecting our currency pair here, Aussie US dollar. We selected a short sell. We want it to be in Australian dollars. Contract size, you need to type that in, $94,000 contract. So, just showing one day, it's telling us that we would be paid $3.86 a day in interest. So as opposed to paying interest, here we will actually be receiving it. So interest is actually working in our favor for our short trade on the Aussie US dollar. Okay, so down it goes. Obviously, you could be moving your stops down along the way. It's kind of a question mark whether you'd move your stop so early in the piece, but you could have. If so, that may have hit your stop there. Otherwise, if you left your stop above the peak, you'd be fine. But just also highlighting a pyramid signal now where you could add to your position at this point. So the pyramid signal occurs when we get an upturn on the moving average there like that, and we get a close below the moving average, suggesting a resumption of the downtrend. So pyramid signal to add to our position at 0.7040, and we're buying $47,000 contract, so half of our original purchase roughly is the idea. Stop loss goes above the last peak from where we're pyramiding at 0.7057, and we've just added to our position. So once again, the suggestion is you just add to your position once to give yourself the best chance of maximizing the profit out of the pyramid trade and overall being profitable with it. If you did on every pullback, you might find yourself doing it towards the end of the trend and creating a bit of a loss situation on that pyramid trade. All right, so let's go through the risk associated with our pyramid trade. So again, we're trading the Aussie US dollar. I'm using the profit risk calculator here just to work this out. So trading the Aussie US dollar, we want it to be in Australian dollars. We're doing a short sell and our contract size is a $47,000 contract. We're opening the pyramid trade at 0.7040 and stop above the peak, last peak at 0.7057. It's telling us we're risking $114 roughly, which is not too bad for a pyramid trade. Well and truly under 2% risk, that's for sure. So it's quite an acceptable risk for a pyramid trade, and we're pyramiding with a $47,000 contract, which is half of the original purchase, which was a $94,000 contract. Now, the carry interest associated with the pyramid trade, so we're going to be, again, still paid interest here because we're short selling the Aussie US dollar. So short selling Aussie US dollar, $47,000 contract. For each day we hold this pyramid trade, we earn another $1.93 per day on top of the other interest from the initial entry. So we're making some good interest for each day we're in this trade as a carry trade. So this is a typical carry trade where we are being paid interest. Sure enough, down it goes, continues in our favor. Again, the stop can be essentially 6 dots back from the last parabolic SAR dot, if you like. Essentially at the time of this screenshot, the trade was still running. So you had not actually been stopped out at this point. It was still going down and going well. So you either get stopped out 6 dots back, that's where your stop would be, or you're waiting for the moving average to cross up through the third last downward pointing parabolic SAR dot, and then you would exit the position. So either of those signals would be a stop out. So just calculating the profits at the time of that trade. So in this case, we've got the carry trade calculator out. The trade at that time was running for 5 days on a $94,000 contract. So that's our initial entry there. So 5 days in the trade short on the Aussie US dollar with a $94,000 contract, we received or were paid $19.31. And with the pyramid trade, where we added another $47,000 contract, the number of days held up to that point in time was 3 days. So there's another $5.79. So basically, up to that point, we were being paid $25.10 in total in interest, which is not too bad as opposed to paying it. So we were receiving it. And gross profit from the initial trade, initial entry for the short sell at $94,000 contract at 0.7047, right up to where it was trading essentially at 0.6976, was a profit of $957 roughly up to that point from the initial entry. The pyramid trade with the additional $47,000 contract at 0.7040 basically was an additional profit of $431 there. So gross profit from the trade, $1,389. Net profit, including the carry interest we were receiving, was $1,414.14. So a very profitable carry trade for a short seller on the Aussie US dollar, and it is a great example of a carry trade in that we are being paid interest. We're not having to pay it out. So that is a short sell example, in conjunction with a carry trade.